Very good morning, everyone. How are you? I hope you all are doing good. So, welcome back again in the editorial analysis. I'm much better, much better. Recovering from cold gradually. Okay, it takes time. But thank you for your concern. And let's begin with the editorial analysis, right? So, today we are going to do basically two analysis here, as you have seen the thumbnail. So one is regarding MF Light regulations, which are supposed to be implemented by SEBI, okay, and the other one is the RBI and the RBI monetary policy and the climate. We will discuss both of them. So these are for your 6th, 7th and 8th July. 7th was since Sunday. So on Sundays, there are no relevant editorials. So effectively 6th and 8th we have covered. We will also cover the remaining newspapers. Also, one more thing, as I have been informing you, that I'm not taking those editorials which are talking about माइक में क्या प्रॉब्लम है, आवाज साफ नहीं आ रही है. Is it good? Okay. दिक्कत माइक में नहीं, दिक्कत आज आवाज में है मेरी. Okay. So, all right. So, I'm avoiding those editorials which are talking about the what budget should present, right? Because now we are going to have the budget very soon, right? 23, as you know, 23 or 24. So the budget will be presented. After that, we will discuss all those articles. So 6th, 7th and 8th July are covered for today. First news which we have is very, very important. So this is interesting as well. A bit technical, but once you understand what is this passive funds, what are these passive funds, what are these passive funds and all, then you will be enjoying this editorial, right? So you see the heading, active push for passive funds, active push for passive funds. What is the news? News is, as you can see here, SEBI's push for passive funds is welcome. Voice clear नहीं है. All right. So if you can adjust with this, please do that. Okay. Because there is no technical issue. All right. So you see, SEBI's push for passive funds is the news, is the editorial, right? This has been taken from your 8th July business line. You can go and read the article. After the analysis, you will be able to understand that, right? So SEBI's push for passive funds is welcome, as you can see here. SEBI's push for passive funds is welcome. Now we will try to understand what are these passive funds, why SEBI is pushing forward these passive funds, what are the benefits, right? You will get to know a very different, new as well as very important concept of finance today, right? So that's why I have chosen this title, active push for passive funds. So SEBI is actively promoting the passive funds, right? So as you can see here, passive beneficiary. Passive funds have been big beneficiaries of the record inflows into mutual funds since COVID market low. So basically the author starts with this thing, right? Author starts with this thing. Author says that passive funds have been big beneficiaries. So I will explain what are passive funds. Just try to understand this, that the editorial says passive funds have been big beneficiaries. Big beneficiaries for what? Of the record inflows into mutual funds since COVID market lows. So after the COVID market lows, you see after the COVID there were market lows, right? So but these passive funds have gained after that. Also recently, if you follow, not only in case of India, there are these developed countries. So at the developed nations, at the international level as well, passive funds have been attracting investors. Why is there so hype about passive funds? What is there so interesting about passive funds? Are they beneficial than the active funds? So we will look into it. Then the author says that this category accounted for about 16.5% of the assets managed by the industry in May 2024, which is more than the double of 7% share 4 years ago. Remember this data. This is something only showing why passive funds are gaining importance in your financial market, and that's why SEBI is actively involved in pushing forward these passive funds. So the author says that this category of passive funds, it has accounted for about 16.5%. 16.5% of the assets managed by these asset managers, right? So you have fund managers, you have asset management companies, you know that, right? So like mutual funds only, these are the asset management companies which manage your assets. They pool these funds and then they invest these pooled funds into different instruments. These may be equity, like shares and all, right? These may be securities, like government securities, corporate debt, government debt, right? Yes. So all these asset management companies are there. Now the assets managed by the entire industry, out of that, if only passive funds are accounting for 16.5%, which is more than double what was there 4 years ago, which was 7%, isn't it a huge rise? Yes or no? So there is something regarding passive funds going on in the financial market, isn't it? Right? So that's why this news is important. If you want, you can take down some notes out of this analysis. It will be very helpful for you in all your upcoming examinations, right? So let's see what the author says next. Now, before understanding the author's point of view, before analyzing this news entirely, you first need to understand what are passive funds, right? So first, we will try to understand what are passive funds. So basically, you see, if you try to compare between active funds or active investors and then passive funds, the basic difference is these are also your mutual funds and all these things. So funds basically which are then invested into diversified portfolios, but then passive means they are not in a race, they are not in a race to outperform the indices, you know, which you have. That may be NSE, BSE, right? So NSE, Sensex, all these indices which are there, these passive funds are just mimicking their performance. They try to match their performance. They do not try to outperform their performance. Are you getting my point? Unlike the active funds. So active funds basically they are in a race of outperforming their performance over the long period of time, outperform these indices. Are you getting this, right? So these are your passive funds. Now they don't want to outperform, so they are less risky as compared to the active funds. Are you getting this, everyone? Yes or no? Are you able to understand what are passive funds? Right? So these are invested, they just mimic or they just try to follow or catch up with the indices performances. They do not want to outperform it. That's why, yeah. So basically you hold them for a longer period of time. So risk reduces. Not in a race, meaning they are not intended to outperform the performances of these indexes. They are just trying to match the pace of their growth. Understood? Match the pace of these indexes, match the growth of these indexes. That is what I mean by not being in the race. Okay. All right. Now, so let's see. I have given you a basic idea as to what passive funds are. Let's see. A passive fund basically is an investment option that aims to mirror the performance of a particular market index. That can be, Sensex, Nifty, right? Such as Nifty or Sensex. So it is basically trying to mirror the performance of these market indices. They do not want to outperform them. Is it clear? Now, unlike their active counterparts, so if you compare them with the active funds, unlike their active counterparts, passively managed funds do not strive to outperform the market. This is what I have told you, right? They do not strive to outperform the market. Instead, their primary goal is to achieve returns that closely mirror the benchmark indexes. They just want to, be in the pace at which these indexes are performing. Yes, they can be. We generally do not, we hold them for a longer period of time as compared to the active funds. Have you understood that? Right? Okay. So this is the thing. As a result, the fund manager's role is relatively inactive, focusing on maintaining a portfolio composition that reflects the index's underlying assets. So this is what passive funds are. That's why all these fund managers of passive funds, their role as compared to their role in the active funds is less active or inactive, you can say. Not inactive, but they are not very much actively investing in these funds. So basically you are holding them for a longer period of time. So this is what passive funds are. They are not in a race of outperforming the market, which the active funds do actively, right? So active funds are constantly in this race. They want to outperform their performance, outperform the performance in these benchmark indexes. Yes, even charges are less. We are coming to that point as well. Have you understood this thing? What are passive funds, everyone? Can you please let me know quickly? Once you understand what these funds are, then only you will be able to understand the importance of this decision MF Light by the SEBI. Right? Okay. Understood? Now moving ahead. What is the news then? What is the news? So the news is, considering cheaper costs and lower risks associated with these funds, the Securities and Exchange Board of India, SEBI's move to frame MF light regulations to encourage passive products is a step in the right direction. So this is the news. SEBI is basically proposing, it is going to formulate new set of regulations for passive funds, which it has termed as MF light. This thing, MF light. MF is nothing but mutual fund only, okay? MF light. Now, why SEBI has been focusing on this thing? So you see, cheaper cost, they are relatively cheap because cost of managing them is also cheaper, right? And then lower risk associated, as I told you, we generally hold them for a longer period of time. Also, they are not in a race of outperforming the market. So that's why they are relatively less riskier as compared to the active funds, right? So this is the thing. Considering cheaper costs and the lower risk associated with these funds, so SEBI has decided to frame MF light regulations. So your catch is MF light. MF Lite. So now wherever you read about or there is any question regarding MF Lite, so what are these MF Lite regulations? They are going to formulate or frame these regulations, you know, to encourage. Now these are certain regulations, they are not intended to discourage the passive funds, rather they are intended to encourage something. And encourage what? Encourage passive products or passive funds. All these products in which passive funds are being invested by the fund managers. Understood, right? So this is a welcome step, the author says. Now we will analyze why this news MF Lite or why this decision of the SEBI is in the right direction. At the end, I would ask you, what do you think about it? Is it a right direction? Is it a welcome step or not? You have to tell me your opinion on this, right? So the author says a nudge towards passive products is good for mutual fund investors on many counts. Why are we welcoming this step? Why SEBI has done something very good in the very right direction as well regarding passive funds. So we are trying to analyze what are the benefits, why they have lesser cost, they have more cost to benefit analysis. If you do, so if you do the cost to benefit analysis, they outperform the active funds. So what are these things we are going to discuss? So first point which you have here is says that with over 30 categories of actively managed products means active funds. So these are in comparison. So whatever we have read about passive funds, that is opposite of that, as I have explained you, right? So it says with over 30 categories of actively managed products on every asset management company's menu. So whatever these asset management companies are, which, you know, manage your portfolio, which invest your pooled funds, be it any asset management company, the author is saying over 30 categories of actively managed products are there. So there is this diversity in active funds. When you have so much of choices, when you have so much of diversity, it becomes very difficult to you know, decide rationally, to go with a very informed decision. So it makes your investing a little bit troublesome. Are you getting my point? So with over 30 categories of actively managed products on every asset management company's menu, the investors who are new to mutual funds, so particularly what problem these actively managed funds they have? First thing, diversity. Over 30 categories on every asset management company's menu. Next thing is, those who are new to investment in the mutual funds, it becomes difficult for them particularly to decide which product they should invest into, right? Given so much of diversity, then so investors who are new to mutual funds often deal with problem of plenty. So this is the thing, remember, problem of plenty. So you can use these terms. What is the problem with the active funds? Problem of plenty, and are unable to make informed choices. And then when you have plenty of choices in front of you, you are unable to make certain informed choices, right? And then when you are unable to make informed choices, your investment profit might get affected. Are you getting my point? On the right categories or fund managers to select which categories they should invest in, what fund managers they should select, all these decisions then get affected. So I hope this much is clear to everyone. This comparison between active funds and the passive funds. Are you able to get that? Yes? Yes? Okay, very good. So stay tuned. You will understand this entire thing, okay, after the analysis. Now, moving ahead. So certain benefits are highlighted. So we have highlighted the drawbacks of the actively managed funds or the active funds, right? Now we are going to discuss the benefits of the passive funds. Then we will decide whether this decision is a welcome step or not. So what are the benefits? The benefits, so passive funds, they narrow down the choices. So the solution to the problem only is the benefit. What was the problem with the active funds? Plenty of choices. So problem of plenty, remember this word, problem of plenty, right? Now passive funds answer these questions, these problems. They come up with a solution. What is the solution? The solution is that they narrow down the choices as they mirror the known indices. That's why, first of all, I explained to you what are passive funds. So in the definition of passive funds, we have seen that they just try to mirror the indices. They are not in a race to outperform them. Since they are not in a race to outperform them, they have certainty, they have lesser choices. Are you getting my point? So that's why they are more stable. So they narrow down the choices. Now, when you have lesser options to choose in between, you have more informed decisions, isn't it? You have more informed decisions. Sorry. Right? Then they also shield investors. They also protect the investors from excessive dependence on the fund manager skills. Now, when you have to actively invest, or when you are indulging in investing in these active fund products, so they are riskier because you are in a race to outperform the market. So that depends, or that requires skills of the fund manager. Yes or no? Agree? So if you want to outperform something, it requires state-of-the-art skills, isn't it? So you have to depend on the skill of the manager. But here, since you are out of the competition, or out of the competition in terms of what? That you just want to mirror the performance of these indices. You are not in the race of outperforming them. So in that case, the risk involved with the skills of the fund managers is not there in case of passive funds. Right? So that's why we say, that's why the author has said that they shield the investors from excessive dependence on the fund manager skills and success or failure of a fund house's investment style. So, you know, all these fund houses, asset management companies, they have different funding or investing styles. Some might reap profit, some might fail at some point of time. Right? So this is the thing. Now, this provides shield against all these things. Any risk involved in the investment style of a particular asset management company, or any risk involved with a particular skill set of the fund manager, you will be able to sail through it with the help of investments in the passive funds. So this is another benefit. You can write them down. Okay. I do your recorded sessions. Will RBI annual report will be analyzed further? No, we have completed the RBI annual report. Okay, we have done whatever was important on the side of the RBI annual report, right? So presently we are doing the financial stability report in much depth. Okay, once you do these lectures entirely, you need not go to any terminology. You search any terminology on the Google, right? I am explaining everything to you. So this is the thing. Now, you have understood the second benefit. How do they protect the investors? Everyone, right? So first, narrow down the choices, which was the problem with the active funds. Second, protecting the investors against these kind of risks. What kind of risks? Risk involved with the skill set of the investors or the fund manager, or any particular investment style of a asset management company, right? Next benefit highlighted here is passive funds are also an option for investors with lower risk appetites, right? So if you want to invest in something because you have a lower risk appetite, in that case, passive funds are a better option for you. Right? Now, next, more importantly, active funds in India are finding it a tough task, you know, to beat their benchmarks. So their purpose is what? Beating the benchmarks, isn't it? Yes or no? Right? Beating the benchmarks. Benchmarks of what? Say 10-year performance of these benchmark indexes, right? But presently, what the problem with the active funds is that they are finding it difficult to even beat their benchmarks. So they are finding it difficult to outperform these indexes, their performances, right? So at this time, when they are finding it difficult to do what they are meant to do, Then comes an option of passive funds, isn't it? So these are the basic benefit points. Also, more are coming in the analysis. So these are certain benefits highlighted. I hope you have understood them. Now moving ahead with more benefits. Then the author has highlighted that there's this paper which was released by SEBI itself. So SEBI last year has released a paper which shows what, that that they direct or regular plans, only 27 to 66% of the active funds were able to match or outperform their benchmarks over 1 to 10 year time frames. So this is related to the last point which we have discussed, that actively managed funds or the active funds are finding it difficult to outperform these benchmarks, right? And the SEBI's paper only, so it is the most authentic data you can have on that, right? So this paper says that only 27 to 66%, only 27 to 66% of these active funds were able to either match or outperform their benchmarks over 1 to 10 year of the time frame. That means that active funds are somewhat lagging behind in their performances. Yes or no? Are you able to get that, everyone? Agree or not, right? So this is the thing. Next thing which the author highlights is that passive funds are already far cheaper. So the next benefit which we have is that they are very cheaper in comparison to the active funds. Why are we saying that? Because passive funds are already far cheaper for investors to own than active funds, right? Why are we saying that? I'm coming to that point. So while index funds and the exchange traded funds, these all are the examples of your passive funds, right? So there are different categories of your passive funds. Okay, exchange traded funds, as you know, they are generally traded intraday. Okay, so same day trade which you do, and then you unlock the profit at the end, right? And index funds, you know, they are much safer. So which one is the safe? Which is involved in the intraday trading? You know what is intraday? Everyone knows what is intraday? Yes, right? So intraday, same day trading which you do. Yes, okay, very good. So it is much riskier. You see, there are huge losses people have incurred in the intraday, isn't it? Huge losses. Okay, there are gainers as well, but then losers are more. Okay, if I say. So in that case, intraday, so ETF are actively involved in intraday, exchange traded funds. They all are examples of passive funds only, that forms of passive funds only. Okay, but then these index funds are very much safer as compared to the ETF, right? So now the author is saying, while the index funds and exchange traded funds, or while the passive funds, they basically charge, say, a maximum TER, total expense ratio of 1%. Okay, but TERs on the active funds can go as high as 2.25%. So what is TER? Total expense ratio. Total expense ratio is basically the cost which these fund managers, they have to incur to manage and operate that fund. So they charge you because they have to maintain, they have to operate, they have to manage that fund. So it is the cost involved in managing and operating these funds. Have you understood that? Right? So this is what we mean by total expense ratio, TER. So maximum TER for your passive funds is, say, around 1%. While on the other hand, the TERs on these active funds, they can go maximum to, say, 2.25%. Right? As high as 2.25%. So which one is costlier? Tell me, active one or the passive one? Active one, right? So the data only shows clearly the active one is the costlier. That's why we say passive funds are already far cheaper. Why do we say that? You have the data in front of you. TER, total expense ratio, we have talked about, right? So the expense of managing and the operating the fund house or the fund, right? Now moving ahead. While SEBI has been grappling with the issue of trying to reduce TER caps, so SEBI has been trying to reduce these TER caps, for these funds, okay, for active managers, but encouraging more passive funds may be a simpler way to achieve such reductions through competitions, right? So always think like that, like this. Trying to restrict someone from operating certain kind of things is easier, or trying to promote someone for something is easier? Tell me. So trying to restrict these TERs, total expense ratios, which they charge on active funds, would be easy for SEBI, or promoting something like passive funds because they are cheaper in comparison to the active funds would be easier? So restriction or promotion, right? So promoting something has a positive connotation attached with it, so it has more benefits in the system, right? Very good. Okay, good. So this is the thing. So author is saying that it would be simpler for the SEBI as well. It would be simpler on the part of the SEBI as well to promote these funds rather than restricting the TERs on the actively managed funds, right? Now moving ahead. Now, what is the way ahead? So what is the author says in conclusion, basically? So finally, when we have understood the concept of what are passive funds, we have tried to compare the active funds with that of the passive funds, the benefits which we have discussed, right? Now the author says that a few aspects of the MF Light regulations need fine tuning. It is good, it is a welcome step, but there are few aspects in which we have to establish, or the SEBI has to establish, fine tuning. What is the author says? The author says that the regulations seek to introduce these regulations also. This is another important information for MF Light. So MF Light, now they are aiming at promotion of passive funds, right? But one more thing which is there, that they are planning to introduce a new category of these passive funds, which is your hybrid passive funds. Hybrid passive funds. What are these hybrid passive funds will be? So hybrid means here you will have options for equity instruments as well as debt instruments, basically. So they are creating a hybrid passive fund category. So here you will have products related to equity market and the debt market. So in equity you will have shares, stocks, etc. And then in the debt market you can have government or corporate debt related instruments or debt raising instruments. Have you understood that? Yes or no, right? So the regulations, these MF Light regulations, they also seek to introduce a new category of hybrid passive funds which can replicate a composite index comprising fixed proportions of equity and debt. They will also replicate these indexes only, but they will have fixed proportions of equity as well as debt. They will have fixed proportions of equity as well as debt. So you understand the difference between equity and debt raising instruments, right? So debt raising are basically debt via which you are raising debt. So all these instruments like government securities, dated securities, or your corporate securities, corporate debt instruments, right? And then equity, you have shares, stocks, etc. Which gives you what? So equity instruments gives you what? Yes, anyone? Tell me. They give you what? Ownership? Okay. Good. So this is the thing, right? So author is saying basically that hybrid passive category, when you have created a new category, so you will have to manage these things together. You will have to establish a fine tuning in between them. Okay, next, the move to encourage passive products must also go with fostering further innovation in index construction itself. So the author is saying it would be more beneficial for the system or for the economy, for the investors, if also along with promoting the passive funds, passive investors, passively managed funds, if you also try to increase innovation, if you also do not compromise on the innovation part, innovation front of index construction, the responsibility of which lies with the exchanges only. Okay, so index construction, constructing these indexes which you have, NSE, BSE, or deciding the base price, deciding all these things. So all these decisions related to index construction which are vested with these exchanges, National Stock Exchange, Sensex, BSE, all these exchanges. So this is the thing, right? So author says that also focus on innovation along with the promotion of passive funds. SEBI should also go for uniform applicability of MF Lite across all passive schemes. Also fine tuning, as we have seen this first point, SEBI should also go with uniform applicability for this. The author is highlighting, right? Uniform applicability in sense in relation to what? All the passive schemes which you have, all the products related to passive funds which you have. So they should be uniformly regulated under MF Lite. Discrepancies should not be there. Otherwise, you will have loopholes in that case. Have you understood that, everyone? Yes. So now tell me, what do you think? This decision is a good one. It has a potential of attracting more investments or no? Welcome step. All right. Everyone thinks so, right? So now you have understood what are passive funds. What is the concept of passive funds? What is the comparison between active funds and passive funds? What are the drawbacks of active funds? And then what are the benefits of passive funds? And then we have seen all the benefits of this decision, and we have seen what the SBI should further do to make this decision MF Lite more effective, right? Yes, less risky, cheaper, and regulated as well. Very good. So I hope this was useful for you. Now we have another editorial in the series, right? Now this is something which we have already discussed, but again, you should remember. So these are two individual topics in your RBI Grade B exam as well. So you have sustainable development and then you have monetary policy as well, right? Combining both of them is what this editorial talks about. So that's why I picked up this article. You will be able to gain some useful insights out of it. Okay. So this has been taken from your 6th July business line. Okay. You can go and read about this. So it has been taken from business line of 6th July, right? So as you can see the title, the editorial or the author here talks about how RBI can tackle climate change induced inflation, right? So basically, this debate is going on all over the world as well as at the national level, that inflation is being climate driven nowadays. If you remember the RBI annual report classes as well, we have discussed that this inflation which we are facing today primarily is climate driven. So is there any way that the RBI can, include, or it can establish parity between monetary policy decisions and the inflation parameters? If we actively track the inflation parameters, will we be able to mitigate the impact of climate change on the inflation? This is the thing, right? So it would be interesting. Let's see what the author says. So basically, the author talks about that climate change can hinder growth destabilize prices, and threaten financial stability. So climate change is, as you all know, we all discuss about this, right? We all are concerned about it. There are various steps being taken by governments, by different stakeholders, individuals, activists, organizations all over the world. But one aspect which we are ignoring is inculcating the climate change related decisions effectively in your monetary policy decisions. Why is it important? Because climate change impacts are not only restricted to environmental aspects, they can also have spillover impacts on all these performances. It can destabilize your financial system, it can destabilize your economy as well. How? So let's look at it. Okay, so while there have been discussions and measures taken by central banks worldwide to minimize the impact of climate change on financial stability, inflation has emerged as an area of concern. Despite central banks all over the world taking it seriously, they are trying to combat the impact of climate change. There is one aspect which is still badly hit by inflation, by climate change, and that aspect is inflation. If you see, still the monetary policy committee, whenever happens, meeting, whenever happens, it is expected it will not reduce the key policy rate because inflation trends are higher. Now you also understand that inflation, this inflation which we are facing, due to which the key policy rate has been kept higher, is not demand pull. This is something coming out of the supply side, right? So this is basically supply driven. In that case, climate change plays an active role. So let's discuss it further. Also, this is something which is highlighted by the RBI itself. If you remember the RBI annual report, in that case, in that report also, we have seen the figures have been given by RBI that climate change is affecting, heat waves are affecting the manufacturing capacity, the efficiency in the manufacturing sector, isn't it? Right? So RBI itself has highlighted, climate change as a supply side shock. So climate change, so you can write these lines, write these things. Climate change is not only a threat to the environment, it has also taken a new picture. So climate change now is a supply side shock as well. I would suggest you can maintain a register or a small diary, write all these interesting phrases and then use them in your descriptive. It would fetch you very wonderful marks. Okay. So now climate change is seen as a supply side shock. This is not something which I am saying, it has been said by the RBI. Okay, supply side shock. Why? Because it is contributing to persistent inflationary pressures which we as an economy are facing right now. It is contributing to persistent inflationary levels, inflationary pressures, particularly from extreme weather conditions, as well as erratic rainfall, right, which could raise headline inflation by about 100 basis points. So RBI has only highlighted that these erratic rainfall patterns, disturbing rainfall patterns, and then your extreme weather conditions like heat waves, which North India has recently faced, all other parts of the world and the country have also witnessed, all these conditions, they can actually increase inflation by about 100 basis points. This is very alarming, right? If we do not mitigate it, if we do not take it seriously. So the recent Purchasing Managers Index as well. So what is PMI? You know what is PMI? Purchasing Managers Index. Purchasing Managers Index. Yes, anyone? Yes? No? Okay. So basically Purchasing Managers Index, is an indicator. It gives you an idea of how manufacturing industries are performing. So it is an economic indicator which gives the trend or the performance regarding the health of the manufacturing sector, their economic trends, their performances, right? So major industries are covered in this. Okay. Yes, manufacturing as well as services, right? So it gives you trend, economic performance of the manufacturing as well as the services sector index. Okay. So this is the thing. So this purchasing managers index survey, it is a survey based index, right? It surveys all these industries and then publishes the index. So PMI survey has shown that, you know, manufacturing activity fell to a 3-month low of 57.5 in May 2024 from 58.8 in April 2024. Not a much difference, right? Time is not something which is the deciding factor here. So you see, almost within 1 month, okay, this has declined to a low of 57.5 from 58.8 due to heat wave. So particular reason is also attached here. The particular reason is heat waves. Right? Now RBI should allocate dedicated resources to track indicators like crop conditions. No, that is why this is an alarming situation. And why are we saying that we need to incorporate these indicators in monetary policy decisions? So how can we do that? Only when we have funds allocated to resources allocated to track such indicators. Then only we will be able to understand their trends. Then only we will be able to mitigate any impact if we conclude that there is any impact which can be there of these patterns, right? So what indicators do we need to track regarding climate change to include them in the monetary policy decisions? First is crop conditions. Second is water availability, energy demand fluctuations, supply chain resilience, all these things which they indicate the impact of climate change on your agricultural and allied sectors and other sectors. So once you track these indicators, what are the crop conditions, what is the water availability, what are the energy requirements and the trends, supply chain situation, what is the supply chain situation going on. If you actively track all these indicators, they will give you a hint as to what their performance can be in future course of time, and then that result you can incorporate in your monetary policy decision, right? Understood? So this is the thing. Now what do you need for that? You need funds for that. Now this is something, you know, which RBI solely cannot do. RBI has a lot of work to do. This is something which government is well posed to implement. So here comes an importance of coordination between the government of India and the central bank. Once they coordinate effectively on this issue, this can benefit the entire economy. So government can, you know, invest, or they can establish, or they can allocate funds for research and development, R&D in these sectors to track these indicators, create infrastructure for tracking these things, right? You need infrastructure for that, and that input can be utilized by RBI to before implementing the monetary policy for that, and that's how we will be able to mitigate the impact of climate change on the inflation. So government's role is also important here. Are you getting my point, everyone, right? Now this can inform, so if you track all these things, this can inform timely policy interventions and facilitate contingency planning, any planning which you need to do if you foresee any such emergency situation or negative externalities on the productivity of these industries in the economy, right? So now I have used a new word, externality, which I want you to note it down because it is useful when you write your answers. So rather than you know, writing this entire phrase, negative impact of something, use these words, externalities. So externalities are what? Externalities basically means externalities basically mean whatever an economic activity or any activity, the impact it has on its surrounding is basically externality, right? It can be positive as well as negative. Externalities can be positive as well as negative. So the impact can be positive as well as negative. What are positive externalities? Say you are residing somewhere where there's a park and some good activities are going on, so it has good impact on your activities, right? So negative externalities example, can you give me? The most prominent issue, most alarming issue which we are dealing with at present at the global level, negative externality. Pollution, very good, right? So all these things are there. War, okay. Greenhouse gases, very good. Yes, good examples, right? So this is the thing. Now, once we are well informed about any such phenomena, then we will be able to mitigate them, do contingency planning for that, you know, by detecting emerging climate induced bottlenecks and price pressures early on. Then we are saying that engaging with the government on this issue would position the RBI at the forefront of evolving a policy response to the climate change. As I told you, this is something which RBI alone cannot do, or if it would be better to say that it would be very difficult to do. Why? Because these are the responsibilities, you know, of the government to develop the infrastructure for that, right? So government, if plays its part effectively, government creates such infrastructure which helps you monitor all these indices and indicators, which helps you get real-time information, and then you are able to predict any such circumstances, any such trend, any such negative externality which can affect the price level of commodities in your economy. Then you will be able to mitigate inflation, particularly these presently what you are witnessing in your economy. There's this thing, you know, like food inflation, right? So food inflation is the main contributor presently, as we have discussed. So there is a difference. So core inflation is although moderating, but headline inflation is picking up because it has food and fuel into it. So in that case, we will be able to monitor it and then contain it within our desirable limits of 4 plus minus 2%. And that would help you, that would help the central bank keep the key policy rate lower. In that case, it would boost investments as well in the economy, right? So this is the thing. Thank you so much, Shovik Roy. Okay. So this is the second editorial which we have completed. Any doubts which you have from today's class? I hope you have understood what the editorial is trying to convey you, that you need to, now you have to write this thing into your answers, remember, okay? You have to write these things into your answers. Shantanu Singh, no. No for what? Not understood or no doubt? All clear? Okay. Yes, you are, you will have MCQs. If you are in the Telegram group, they are uploading the MCQs as well, okay? So you see the Telegram group, you have 150 questions. If you do them on the RBI annual report, then your preparation would be complete, okay? So try to use these editorials in your answer writing practice, okay, in your descriptive as well, to fetch more marks. So remember, climate change is not something isolated from monetary policy. It has to be integrated very effectively. This is the thing which we have discussed. And also remember the MF light regulation of SEBI, very good initiative, and you have understood the passive funds concept as well. Thank you so much. Thank you so much, everyone. I hope you capitalize upon all these lectures. They are of benefit to you. And thank you so much. I'll see you in the next session. See you in the next class. Have a very good day. And we will cover the remaining editorials as well as soon as possible. Okay? Need not worry about that. Have a good day. Thank you so much.